Okay, folks, how are you? Weekly review. This will be brief, only because the teaching portion I'm going to do on Monday evening. So we're just going to go through the salient points for analysis and then pick it up on Monday. All right, so dollar index. We have our weekly SIBI that will be rebalancing at 98.40. I'll just give you a real quick snapshot of that. That's this one in here. I still think it's relevant for where we are right now. From the weekly, we dropped down twice into this order block, waiting to see if there's any accumulation that's being seen here. We'll see it probably this week if it's occurring. I like the fact that we are wicking in here and they're coming off the lows. To me, with the order block on a weekly basis, it to me supports the idea that there could be accumulation going on there, all the declining on the dollar. Run above these highs, that will be the upside objective for the next 2 weeks. What changes that is we trade below this swing low. So if we break down entirely and go below here, all bets are off, and then I'll have to move to the sideline and wait for more information. Right now, I'm sticking with the bullish dollar. It didn't break down all that terribly last week. It's still relatively consolidated from this low, and then last Friday's high. We're still inside of that range. So last Wednesday's low to last Friday's high, still in that range in consolidation. Nothing's changed, even though if we go down to a 1 and 5 minute chart, obviously it looks like it's bearish, but it doesn't show that bearishness, at least in my opinion, here on the daily. Okay, so this is what I mean by sticking to a long-term narrative and trying not to pick tops. And the reverse would be said for trying to pick bottoms. On the hourly chart, you can see that we had really nice little runoff on Thursday. Took out pseudo equal lows, closed in an imbalance here, and then traded right below the body of the candle here. So what we do going forward, the upside draw initially is the buy stop liquidity pool here, and we have a small little void. So this is a SIBI, sell side imbalance, buy side inefficiency. Then you want to come up there. I like the equal highs here. I like that. So I like to see the liquidity tapped in here. Look closely, go to the left. What do you see? A gap. See that? So we have several things here, and it's also a breaker. Look at that. So we have that area, and right there. So we have this gap they could fill. We have buy side liquidity pool, equal highs, Candyland basically, and then what we see after that, if it goes up there, I may be wrong. It may not even go up there. It may go lower, but I'm looking for reasons to justify long dollar, short currency, foreign currency, against the long dollar with the dollar going up to here. Now, how do I use this information? Well, this framework, if I can get a trade idea on Monday or Tuesday or even Wednesday, and I see the dollar run this area up here and close the gap or just run above these highs, I would absolutely be looking to take 80% of the trade off, because it's at an area where I think it's critical. So in other words, it could run up here, clear that, and then become very bearish, or it could trade through here. I've taken some profit, and then it continues higher. I still have a position on. Okay, so it's not about being right. It's about being profitable. So again, just because I'm saying that this is where I think the dollar may want to trade to this coming week, doesn't in no way mean that it absolutely has to do that, and I'm committed to a trade idea right now, because there's no trade. There has to be a setup forming based on this narrative. Okay, dropping into a 15-minute time frame and zoom out a little bit. Nothing really too thin except for the points of price I've already mentioned. The market does have pseudo equal lows here, so I'm giving it the benefit of the doubt. If it trades higher or gaps up and trades down into gap and fills it, then reaches up into here, that would be the ideal scenario. That's what I'm ideally looking for on Sunday. So if we were to have a gap higher opening on Sunday, a whiplash setup would be selling the open, waiting for a gap to fill. I'm not saying that this is a price where it's open. I'm just graphically describing it to keep me on point with what I'm saying. The higher gap opening, if we sold at the opening and closed the short at the closure of the gap, that is whiplash. And then catapult would be buying once the gap is filled and trading in the direction of the initial gap opening. Okay, so and then you would run for a liquidity pool above an or high or closing a fair value gap above you. A bearish whiplash would be an opening lower and then buying at the opening and then waiting for a fill back up to previous day or Friday's trading. And then once that gap's closed, you would exit the position. That would be a whiplash. A catapult or bearish catapult would be then entering short and then trading in the direction of the initial gap. Okay, so in context, I would rather see it gap up. It doesn't have to be a large gap, but I'd like to see it gap up, come down, fill the gap, and then trade higher. I'd like to see that. Now, if we do gap lower, and it doesn't have to gap at all on Sunday, but if it gaps lower, I'd like to see it trade higher, fill the gap, and then make an attempt to go lower, and then trade back above the gap, and then the gap should act as support. And I've taught you that before in previous months' reviews. So that's what I'm expecting to see. It does not have to have a gap on Sunday. Okay, given what we're looking at here, it probably won't gap. The reasons why is because we're in a low volatility condition right now on dollar. Buy side liquidity pool still untapped. Relative equal highs still there for euro dollar. We did press higher from a relative strength standpoint. We have been mentioning how euro has been the stronger of the two between it and British pound versus the dollar, and we saw that price action shown in euro dollars trading last week. Still hasn't had a considerable upside move, but if we get that dollar index to slip lower, this is where we're going on euro. So we'll do that here. I goes right there, and then the initial upside objective would be these equal highs. Now again, that's the argument for a bearish dollar, or if the dollar stays in a consolidation. This may need to get back in line with what has been seen on the British pound. So in other words, what we saw on British pound, we had a nice little rally up here. Euro has been rather lethargic in trying to do the same thing. So if we get up to this area here and you are able to take a long, you want to be taking something off because we will be really paying attention to the SIBI here, sell side imbalance, buy side inefficiency. Split that range in half, and then you have your consequent encroachment. That would be a realistic objective. It doesn't have to just go right to this high or even fill. We want the middle of that. So if we take something off there, if we're long, I'm not saying we're long or looking for a long, but if I get a indication on Monday that the dollar index is really showing no willingness to go higher or lower, or that it's going to go lower, then I will be hunting longs on euro dollar with the objective of reaching up into the buy side liquidity pool here, BISI, consequent encroachment, upside objectives, and then if we get some kind of upside rally with a lot of magnitude and momentum, this would be the area. We have equal highs, nice liquidity pool, and a small little fair value gap that has yet to be filled in right there. So 113.40, that could be a nice objective for the week if we get some real legs that run higher on euro. So we drop down into an hourly chart and zoom out a little bit. You can see that we had that volume imbalance here. Beautiful, beautiful delivery. I mentioned this on Twitter. That's what you get when you get a volume imbalance. We've been talking about, we actually mentioned it last week's review. I was watching, and I told you all to watch this. This is what I'm looking at. Price trade down into it beautifully. Traded into it beautifully. And a nice little rally created equal highs, retracement. Traded to the rejection block, which is the lowest close in the swing low. And nice vault higher. We're going to look at this price action in here, and you'll see some accumulation that took place in euro dollar, and ended up making a slightly higher high here on Friday and trading off into the close of the week. On a 15-minute basis, nothing really to speak of in terms of imbalances. We've already closed in what would be seen here. Everything is all about the sell side liquidity pool There's no inefficiencies on the lower end until you get over here. And that would be seen with this level right there. So if we have that and the remaining dealing range low, which is here, you would split that in half for consequent encroachment, and that would be your objective. Again, we're not trading zones, we're not trading, supply and demand, we're not doing those things. We're looking for specific levels, and that would be here. This would be consequent encroachment right there. And you can do this on your own charts on this roughing it out right here, around that 112.07, 112.06 respectively. So let me get that off of there. And that's going to be it for euro. Cable, we gave just about all of the rally from here on the previous week. It gave all that back, and we dipped down below it, traded into consequent encroachment between the high here and the low that went a little bit lower here. This should be sitting on 29.86. So what is this level sitting on? 29.86. Yep, that's what it is. All right, that's that. And if we drop into an hourly chart after we get a fib on here. Here. Bam, handled it. The level is 129.66 and the low is 129.66. There's our consequent encroachment in action. Traded down into it on the 9th and then popped off and moved into consolidation. Now you're probably saying, well, what's the big deal about that? That's the importance of finding the real support resistance in the marketplace and not looking at subjective things and what it looked like in the past, so therefore old support should be considered or resistance broken should be support. It's not that simple, because if it was that simple, everybody would be rich and everybody would be not punching a time clock. But as you can see, there's a lot more people working today than there are traders. So we have a small little fair value gap in here that traded to it here, down here, and then banged up one more time into a mitigation block and then sold off a little bit in here. I like this area right here still. So if we looked at that, going forward and then using this right here, I really like this one, and then we'll get our consequent encroachment measurement on it. If you're new and you hear me say that, what is consequent encroachment? I've talked about it in recent weeks in the reviews, so do the work and dig it out yourself. I don't know exactly which one it is, but I think I've mentioned it. So we have this level here, 129.63. That'll be interesting. It's also right below this swing low. This is all that's necessary to fill in this, but it can come all the way down and fill it at the 129.55 level. Okay, so once it gets below that, you have a small little fair value gap right in here that takes us to this candle's high in 129.46. So your question is right now, okay, well, you're pulling all these levels out. Which one do I trade? Well, we're up here right now. So if we get a sell-off, they would be targets. Okay, so that's what we're using it for. When I give you these levels, I'm not saying, okay, look at all these numbers, and I'm going to come back next Wednesday or next Friday and say, look how smart I was. It bounced here, bounced there. We're up here. So if it's likely to sell off and then we get a firmer dollar or the dollar consolidates and cable sells off, these would be downside objectives. Okay, that's all I'm stating here. And we go back and we study what the setups were prior to those levels getting traded to. That's how you build your reticular activating system. And if you do that over a period of time, you start seeing the recurring patterns that I talk about in concept, and then you start to go in and you start seeing it. And then you can start seeing it before it forms, the signatures that you pick up by studying past examples. By me pointing to these levels in advance, there's no plan B explanations. I already told you where to look for in the beginning. beforehand. And then when the market trades to these levels, and it doesn't have to always trade on that. In fact, last week we saw the dollar slip. I was expecting it to trade a little bit higher, and we saw slippage on the dollar, and it went lower. Didn't really break any market structure to speak of on the daily chart, but I wasn't right. But I also mentioned that it was going to be a week where I was uncertain, and I wasn't really sure about what I wanted to do. And you saw I only had really 2 trades last week. I was trading in the dollar CAD and the cable, and that was it. That's all I did. So the takeaway is, when I say things, if you have uncertainty about it, or if you have a question about it, obviously you want to record it in your journal, because you're going to find the answers either in the very next week's review or the very next review, like next Wednesday when we do another review, because Monday is just going to be a teaching session. I'm not going to talk about the markets as a real-time thing. I'm going to teach you something on Monday. So it's just a lesson. But when we do analysis like this, I want you to remember the things I'm telling you, and then watch how those levels are important in the coming weeks. So if we get a reaction, or if we get a trade that trades to them, they'll be more meaningful to you, okay? Because it teaches visibility, it teaches depth of understanding, because I'm showing you before it happens the signatures that leads to me thinking about these levels in the first place. Otherwise, it's just me demonstrating my toys to you again and not really teaching. So if we drop down into a 15-minute time frame, and we zoom out a little bit, not that one, zoom out a little bit, really there's nothing really to speak of in terms of inefficiencies except for what I've already highlighted, and that's over here. Okay, so on the upside, nothing really terribly exciting. There's a small little one in here, but to me it just looks like it wants to go lower. We tried several times in here. We went above these equal highs here, and then one more time for good measure, and they swept it. So it depends on what we do on Sunday's opening and on Monday's trading. So we're waiting again to see what we get in terms of volatility or lack thereof, to see what we get. And on Eurodollar for SMT overlay, we had divergence in here on Friday. Nice little divergence during the London session. Failed higher high, lower low on cable, failed lower low on Eurodollar. And I mentioned we would see this as accumulation during the New York session on the 10th. Price popped up really nice there. And on the overlay for cable, I drew on the actual divergences so that we can see them. Failed higher high, lower low wasn't seen, just like the lower high was formed. So this is symmetrical, but watch, this is not symmetrical. Okay, so we have cable making a lower low while Eurodollar was making a higher low, and at the same time dollar index was already failing to go higher. So this is a run on stops. It's a sell stop run or rate on sell stops. So anyone that was buying here or buying here, they get knocked out, and then the real move takes place, running out equal highs. So on this day here, the signal formed from the accumulation of sell stop raid, okay, or turtle soup, or external range liquidity, as you learn about it in the mentorship. And this is an internal range liquidity entry. External range liquidity entry here in New York, internal range liquidity entry on New York for Euro. Both moved up nicely. Both had really respectable runs. Looking at previous highs, do 10, 20 pip extensions on this, the sweep, and you get all of the daily highs and lows pretty much. For charter members or those individuals that have gone thus far into the levels that talk about the central bank dealers range, flout, and Asian range deviations, you also would be encouraged to look at these levels here because it overlaps rather handsomely with them. And again, on Friday you can see the lower low on cable, not seen on Eurodollar as you expected. So now again, higher low, lower high, that's symmetrical, but that's not symmetrical. This is a run on stops. So when we see this, as soon as you see that, you have one of two choices. One, you can use the bullish order block or fair value gap entry on the Eurodollar, or you buy the sell stops as prices under the low here on cable, and you look for a run above a swing high for counterparty liquidity. In other words, if they're going to run the stops here, you're buying those sell stops. So to get out of that, they want to sell it. Okay, so they're buying someone else's sell stop. They're getting knocked out of the trade. They want to go long. They've knocked them out. Their sell stops have been taken. So now smart money holds a long position. They want to sell it to be profitable like anybody else. So where would they sell it? At an area where known buyers would exist. Okay, right above here, buy stops would exist because those individuals that are short, their stop is going to rest up here. And if they're short, they're protecting their position with a buy stop. So there's a willing pool of liquidity of buyers up here. So buying below this low and selling it above this high. Not just above this high, but at layered levels of liquidity. And that's how you do the extensions on or deviations on central bank dealers range, flout, and Asian range on this day. And you'll get this level here. And you'll also do the 10, 15, 20, 25 pip sweep protocol that we do for previous highs and previous lows. And then also will be rather handsome with this level as well. And that's going to be it, folks. Well, no, it's not, actually. The cable. I'm sorry, not the cable. The dollar CAD. I mentioned that I was looking for, this day we were looking at, it was indecisive candle, that was Wednesday, and I said I wanted to see some expansion. Now, granted, we got it on Thursday, but not much. I wanted to see it sweep above here, and again, the long-term draw is back here. It still is for me here. It hasn't broke market structure yet. It hasn't done anything for me to turn the tide. Yes, there was a decline on Thursday and Friday, but the initial run you saw I was able to capture that movement from the open and the rally up. I took profits above a short-term high. Now, this is what I used. This is the draw on liquidity, the rejection block, which is the highest up close candle, the close. We're going to drop down into an hourly chart. You can see that's that rejection block here, and look what's over here. Buy side liquidity. Okay. I'm not sure what just happened there. Oh, let's see. I put it in the wrong one. Here we are. That's how you do it, Michael. You just started or something? Noob. All right, so buy side liquidity pool resting here, and the spike up above that was the catalyst for me to want to exit. There was just simply nothing supporting it. Also, remember on the 9th, okay, right in here, on this run up, as it was running into new highs like that, above equal highs, watch what happens, okay? We have this candle here, which is 1300 on the 9th. Now, if we go over to the 9th, 1300, and 1300 is right there. 1300. Good grief. Well, you already know what I'm pointing at. It's the low here on cable. That's 1300 there. Okay? So as it's making that lower low, remember what's going on? At the same time on Euro, on the 9th, there's that higher low forming down here. So Euro and cable were diverging, and that's this right here. Okay, it's this whole setup here. As this occurred, this was the reason why I bailed on the run on the dollar CAD, and I did not suffer all of the drawdown here. So I was wrong in my analysis about expecting it to have a sizable run, or likely sizable run, on the upside. But I had already gone into last week's narrative that we're still unsure, but I'd rather play the long side than the short side because I felt that it was going to want to expand. It expanded and allowed me to take profit. But I took the full position off and didn't leave partials on because of the divergence in the euro and cable. Okay, so if I see this accumulation with the support of the dollar failing to make a higher high, this is what you would expect to see here. Higher low, lower high. That's symmetrical, but this is not symmetrical. So this indicated that there's going to be a turn in the marketplace, so therefore the dollar could actually slip lower and allow foreign currencies to rally. If that occurs, or that's likely to occur, that's going to be very hard for dollar CAD to rally unless there's a really, really weakness on Canadian dollar, which it can happen, but it's not likely to occur. More times than not, I'll stand on the side of what I just explained here. So if I think foreign currency, euro dollar, and CAD are going to go higher or have a significant odds of going higher and the dollar going lower, I'm going to be very reluctant to hold or enter long positions on dollar CAD because basically it's the same thing as shorting bullish foreign currency. Okay. And in passing real quick, I keep wanting to say dollar. The S&P traded down to a bullish order block. Consequent encroachment, just a little bit overshot on that. Nice little reaction here. Keep your eyes on this level here. That's all-time highs again. Do I feel that we topped out? No, I don't think we topped out. So even though we had a nice little sell-off, I mentioned it on Twitter that it's reasonable to expect it to sell off. I jokingly said it'd be nice to see it crash. That was just me being sarcastic. But I think that we could bang around here a little bit, going sideways, and then how much of a consolidation we do is important because it may want to trade in a large range. It may want to come down below these lows at some point. I don't know when, so I don't know. But if we trade down in here and close in some of this, and if we do that closure around fall, and you're saying, well, what? Taking that long? It could stay sideways for a while, or it could just tear off and make higher highs and just leave everybody behind. That's fine too. But I would like to see this area here used in the fall, and if we get some kind of an index divergence across the Nasdaq, the S&P, and Dow, that would be ideal because that's the only real area that I'd like, and it would also be running fund level sell stops. Okay, so keeping the framework as it is right now, this is what I'm outlining for you. And this is way, way, way early, and it could really unravel. But it's something on my radar I'm watching. So here's our optimal trade entry right here. So this is our level of importance to me right now. So around that 2800, 2875-ish level. It can go down there, hit the order block, clear the stops, and then rally. Now, it doesn't have to do this. It can drop down here in the end of the May month or in June, and then rally up, make a higher high, and then create that seasonal first week of July high in stocks. And then it goes sideways into August and September, drops down. October, November creates the low of the year when it's bullish, and then takes off and goes higher. That would be a scenario. But right now, this is what I'm looking at. I'd like to be around, hopefully, looking at the charts if it trades down to this level, because if there's some accumulation that's going on, I'd like to be a participant on that and then try to catch all-time highs as a result. But if we trade just right lower into it next week, I think that we're not going to create the scenario I just outlined. I think they're going to attack this low because there's so much time to still build a bullish fall scenario. Fall by that I mean like September, October, November time period. And they may want to take this low out and then trade down into this gap and bullish order block. So the scenario I'm outlining here, if we just drop right on through, this would be the likely scenario for the fall. But I'd like this one because it would create a trading range in here throughout the summer. And I don't care. It's a really small trading range, but it would allow for, if we looked at it in scope of like a measured move type thought process, if we just banged around in here like that, that means we could do something like this. Look at this low to this high, that range added to whatever the low that forms, that could project up. Man, it could take us into 3,100 maybe. 30. No, what would that be, Michael? It'd be more than that, wouldn't it? Let's get an idea here. And again, this is all based on what I'm outlining here. And again, it can all change quickly, but it's just something I'm looking at because I always like to frame potential scenarios that would take place in the fall. Now, if we just run standard measured moves like this, That takes us up into 3,300. If we take it from the level here, say it goes all the way down to the 79% retracement level, right there. Okay, I'm measuring this range low to this range high. That's what this rectangle is doing. I've copied it by holding Control and dragging it so it creates a duplicate, and I'll just drop this whole extra rectangle right on the lowest portion of what I think may be a reasonable retracement level. If it trades there, it clears the stops, trades into a fair value gap, into a bullish order block, and that could be a scenario for bullishness. If that happens, the reasonable expectation would be to see it clear the highs, and then how much of a high extension? Right here, which is interesting because it takes us to target 2 on the Fibonacci. Well, just below it, but on the extension from just a price measurement only, it's just above that target 2. So, and again, the next level would be to take that same range and then add it to the old high, which is here, and that takes us up here, which is around 3,300. But right now, it looks like if we get what I just outlined, take us to 3,100. So I was right. Why did I second guess ICT? What am I thinking? I know it's not for this place, only on Twitter, Michael. All right. So anyway, that's what I'm looking at. I'm looking at this area in here. If we just tear off and don't even come back down here, that's actually very bullish. I like the idea of that. But if it has to retrace a little bit deeper, I'm watching this area here with this narrative in mind. If we blow through this low, you know what I'm looking for. I want to see that same scenario that we've outlined here. Okay? And that, ladies and gentlemen, is going to be it for this week. I will talk with you all by way of a lesson on Monday night. It'll post around 9 p.m. my time, and it won't be anything time sensitive, so you can take your time and relax and maybe watch it on Tuesday morning if you don't want to wait up for it. So I'll talk to you then. I wish you good luck and good trading.